Welcome back, everyone. Been a while, but I've done a few things within my portfolio, and so here is an update. Stocks I'm buying for the middle of May 2021. So very briefly, what today's video is going to include is the 3 stocks I'm buying, context as to what they add to my portfolio or why I'm more comfortable with them as opposed to what they replaced, and other strategies that I'm using around the edges. So my portfolio has had some successes and some failures, but what I'm looking for in terms of adding right now is to increase the allocation to the portfolio that I don't need to babysit. And by this, I mean the stocks that I'm not going to be concerned about, okay, I need to sell them now before they fall. And what does this mean? Well, this means the quality stocks that I'm prepared to sit on for a long time. Obviously, it's unknowable if things will change, but ones that will get better, get cheaper by the day. So why am I doing this? Well, it's always been a sector, a part of my portfolio, I should say, that I've wanted to have and I've had. Now, luckily, when the beta play, the high beta, high volatility names, when they do well, they can catch up in terms of parts of the portfolio. But now I'm looking at a bit of a rebalance, and you look at what are the problems with having too much of the beta play. Well, it's volatile, so it can go up a lot, but it can also go back down a lot. And so there's a constant thought process around, is now the time to sell? And so from that side, moving more money to the type of companies where you can hold for 5, 10, 20 years and think, okay, well, I'm just going to make money here. Well, it might not be spectacular overnight, but the type of companies that, the whole Buffett quote, if the market was going to close for 10 years and only open then, what companies would you want to own? And there's value here in terms of, okay, you look at uncertainty in the future, owning quality, owning companies that will be around and hopefully will be a lot bigger and better per share in a long time. You won't have to sell and pay the tax on part of your gains. And so there's a lot of value in that type of play, especially if you look at, okay, well, let's say there is, an uncertain future. Maybe there's a spike of inflation and that goes away, and another spike or something like, or there's deflation. We can never fully know. And realistically, if there is inflation and it is transient or not, then either way, eventually it'll cycle through from just the sectors that initially benefit to everywhere. And so in that case, you could have some good companies that are a lot higher because the value of future dollars is lower. And if you own quality, the companies will make it through. So one of my other stated goals that I've talked about recently is getting a bit more defensive. And healthcare is one sector that is less correlated to the reopening trade or economic boom times. And so it's also a sector that hasn't appeared in my portfolio until now. I recently bought Viamed, and this is a company that I don't know if it qualifies as ESG, but really I don't really care about that because it's one that helps prolong people's lives. And it does so with excellent growth and much lower costs than peers. And really, I think the hidden gem here is the platform, because they are basically setting up, in order to achieve their sales, achieve their growth, they are creating a cross-country platform. Basically, this is a company that trades late-stage COPD, and they do it with assisted breathing. Now, the interesting thing that there's not really value in the stock because the stock in and of itself is really a growth at reasonable price type of company. It's growing pretty quickly, and the price is really not there to represent that. Now, there are some risks, price cut, for example, but one of the things that's highly underappreciated with this company is that as they grow, they're laying the foundation for a sales network, which I would think has some other value or could be monetized in some other way at a certain point. But again, even if that's completely wrong, I don't think that you're paying up too much for a company, and I think that they are very lean team and net cash right now, so there's not a tremendous amount of financial risk in the near term, at least. So this next stock is basically my answer to this specific scenario that I'm going to lay out. If I had to put all my money in one stock and I could then not access this stock, so the market was closed 5, 10 years, whatever, what would the company be? And bear in mind the implications of this. The market will react to earnings, will react to what it thinks the next person will react to. So in this case, you don't have to worry about what the share price is going to be tomorrow, what the share price is going to be next month, what the share price is going to be next year. You just have to worry about what type of value will the company create over the longer term. So for that reason, my answer would be Dream Unlimited. And I know it's a repeat, sorry about that, but I've added more and it's become a very large position for me, as I kind of suggested it might last time. And why is that? Well, frankly, when I look at this company and over the longer term, so forget quarter to quarter, forget, bounce around in fair value based on some fluctuation, some temporary whatever, I think this is one that when you look out over a multi-year time horizon, look at past, look at the future, I think it's very difficult to lose money on this one over the longer term. It gets cheaper by the day. Yes, their buyback is maxed out for now, but once we get to later in the year, they can renew that, and literally you own a bigger piece of a bigger company every day. Now, I'm not saying there won't be quarters where they have losses because of fluctuations in prices, but over the long term, as I presented in the scenario before, this is a company I really like, and I also believe it's one of the best in breed names in a sector that I think is unjustifiably out of favor. If you look at Canadian real estate, for example, most of it trades at discounts. And at the same time, you look at the population growth in Canada, and it's, depending on what year you're looking at, but it could be up to like 1.4%, which is about almost triple the US, which would be second place in the G7. So this is largely due to immigration, but I think that when you look at the yield you can get on real estate, and B, the discount to book and what you'd find in the private market, that doesn't make too much sense to me in what continues to be a near zero rate environment. So overall, I like that I'm allocated to the space. Now those two are risk off secular growth stories that don't require too much in forms of day-to-day watching. But I am also have been adding to a bit more of a cyclical play. Now, how can you do that? Risk off, but high beta exposure to the risk off play. Well, for that, you kind of probably want gold. So while I think all of the names that I've mentioned in my recent gold stocks I'm watching video are fine ways to play the thesis, the one that I'm reporting that I'm adding to the model portfolio today is Geodrill. Why is this? Well, frankly, when I look across the commodity space, I look at the prices that we're seeing today, so not even higher prices, and I think, okay, if these prices stay, there's a lot of money to be made. So unless prices fall across the board, call it 30%, maybe more, well, then there are a lot of miners and would-be explorers that really the ball's in their court, but they have to spend some money. Where's that money going to flow? Well, to the drillers. The drillers, on the other hand, still really haven't acted like we are in a bull market, which kind of confuses me, because if you look historically, they, can perform just as well as the explorers. And meanwhile, on a company-specific basis, you look back to the history of Geodrill. Look to where the previous cycle, we could argue, approximately peaked. So look back to 2012. Well, gold was 1,600. Geodrill had 33 drill rigs, and the share price was $3 a share. Okay. Most recent quarter, gold 1,800, drill rigs 68, and price $2 a share. Now, I'm no mathematician, but I think that there's less credit being given to the value within the company now. But moreover, I focus on this metric for a very specific reason. In what many would say was a big bear market that destroyed a lot of value and had companies go out of business, this company doubled their rig count, so doubled their assets through tough times. So frankly, I'd be very interested to see what they can do when times get good again, because in cyclical industries, bear markets are the authors of bull markets, and bull markets are the authors of bear markets. And frankly, if they could do well in a period where no one cares about drilling, I think they could do even better in a period where all drillers make money. And so we'll see. And I do want to mention the obvious disclosures that I own all the companies mentioned in this video, and that I will add them to the tracking portfolio as of today's closing prices. I do want to add as an added point, Geodrill was a sponsor of this channel in the past, but I am not receiving any compensation or anything for adding them to the portfolio. This was my choice, my purchase, so you should know that. Now, I also just wanted to say a few words about the overall strategy direction that I'm taking with my portfolio. So broadly, I'm reducing exposure to high beta, cyclical, pro-economic reopening, whatever, cyclical. I do remain bullish for the meantime, but I've decided that what works best with my view of where we are in markets is to express the remaining bullishness through call options. This is because while I believe that there could easily be more upside in the near term, I think we've reached a point where there is significant risk of capital in many long positions. So I'm doing this with the goal of preserving that capital. But the thing is, I don't particularly want to discuss the specific long call options as they're happening on this channel, because they are particularly volatile and carry significant risks. And I'm trying to kind of shift away from that type of thing, because from day to day, from the day that I say it to the day that it opens the next day, there could be significant changes, and I don't really want to go that direction with this type of thing. On the other hand, and in completely separate positions, I have also been writing some puts against some of my favorite names that I think the perceived risk is overblown. The thing is, this is another very risky strategy if you don't know what you're doing, and who knows, maybe I don't. But I'm only writing puts on stuff that I'm willing to buy and against cash that I have on me. So this forces me to have the cash and to be ready to buy if things that I like go on sale and not spend the cash on a shiny object. In fairness, this is probably not the best way of me forcing myself to keep in cash, but with my general dislike of using margin, it is somewhat effective. And just as an example, that I mentioned on Twitter, I normally don't mention things, but I mentioned on Litamar that I had sold some puts before earnings because I didn't think that there was a reason for it to go lower and stay there. If it did and I bought a few more shares, that's fine. I'm fine with that because I didn't think it should go lower. But so companies that I really like that I don't think should go lower, and if they do, I think they're buy. That's the type of thing that I would sell puts against. So as I just said, I don't really want to talk about call options and mention the name of a put option that I was short. I figured I would quickly go over the difference. So the difference, the way I see it, is for me, call options are betting on purely prices going higher of something that I deem risky and don't necessarily want to hold the equity, have that much capital at risk. So that's an offensive bet, whereas puts are another offensive bet, but puts is me saying that, if it falls to that price, I'm glad to buy and hold for a longer term. And I hope you can see the distinction there, but yeah, that's kind of the way I see it. Overall, though, I'm pivoting the portfolio to not only be more defensive, but more balanced, as opposed to what it turned into, which was one giant high beta reopening cyclical. And in my search, I found a number of interesting prospects, some of which I included in this video, which again are not investment advice, it's just what I'm doing. Could be a mistake, could be a bad time to get in, we never know. But I found some other things that are interesting too, and maybe I'll go through some of these in more detail, maybe I'll go through some of those that I found interesting. But for now, I hope you enjoyed this, and until next time, have a great day.